One of my pet sayings is learn with your own capital, not other people's capital.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Arn Cenedella. Arn, how are you doing today?
Todd, doing great. Looking forward to talking real estate with you. We've interacted over LinkedIn over the years, and I think we once met at Best Ever
Yeah.
briefly. So happy to sit down with you and talk some real estate.
Yeah, that's been quite a few years since we, met face to face. And like you said, fairly briefly, you're at those big conferences. There's like so many people. It's so hard to actually have good conversations with people, but that's,
Correct.
that's what they're about. So a little bit about Arn. He is the owner of Spark Investment Group, and is a real estate broker investor with over 46 years of experience in the real estate industry. So I'm excited to have somebody with so much real estate experience. I would guess the typical person that I'm, interviewing hasn't been in the industry, more than 10 years. I certainly talk to plenty of people that have been, but 46 years may be the longest tenure of anybody I've spoken with. So excited to have you on, learn a lot about what you've seen in the industry, what you're seeing today, of course, and all that kind of stuff, but a little bit more about Arn. He joined Cenedella and company, his family residential and investment brokerage firm, located in California in 1978. And, he was a successful broker in the Palo Alto and area, and built a single family rental portfolio, in San Francisco area or California area and Texas as well. And then transitioned fairly recently, actually in 2020, from single families to multifamily. And then so Spark is the GP and sponsor of over 968 units, all in South Carolina. Is that right?
Uh,
Mostly?
Mostly in the Carolinas, but a
Okay.
few other locations, yes.
Got it. So, all right. That's a mouthful. I want to give you some time, give our listeners a bit more about your background, and we'll dive into some fun stuff.
Sure. Yes, got in the real estate business 1978. There was no grand plan to it. I grew up in the San Francisco Peninsula before it became Silicon Valley. And like a lot of middle class American kids, was told work hard at school, get a degree, get a job, and move on. And finished my graduate work, University of Michigan. Decided that wasn't quite for me, and called my dad up. He said, "Hey, come on out, get your license, and I'll put you to work." And so I started as a residential broker selling homes in Palo Alto and Menlo Park, California, March 1978. Started investing in single family homes, and then moved to Greenville, South Carolina, where I now am about 10 years ago. And as Todd indicated, moved to multifamily about 4 years ago, literally March of 2020, when we were becoming aware of how significant COVID was. We started to get inklings, but by March, we knew we had a tiger by the tail, or however you want to describe it. And a young investor friend called me up on the phone and he said, "Well, Arn, what do you think is going to happen to rent collection?" And I said, "Mario, I don't know." Because this was middle of March, already got my rents, and I said, "Talk to me in early April, and we'll continue the conversation." Well, at the end of it, uh, he turned me on to a podcast about multifamily real estate, and I started listening. Really, kind of made sense to me. I could understand the thesis behind multifamily investing, affordability, economies of scale, the ability to put teams together to make it work. And that basically launched me on my multifamily journey. And I would say, um, it was still in the residential realm. A single family residential isn't that much different than smaller multifamily. So it
Yeah.
wasn't a big leap to go. It's not like I started doing retail shopping centers and so forth. So relatively smooth transition, and started as a co-GP, then started being a lead sponsor here in Greenville, South Carolina.
What was that first multifamily? How big was it?
Uh, the first one where I was lead sponsor was 43 units, all one bedroom, one bath. Got it at a pretty good price. This would have been March of 2021. And if you kind of recall back, summer, late spring, summer 2021 is when rents and inflation really started to ramp up, and so we happened to acquire at a good time. And
Yeah.
43 little one bedroom units, 2008 build. Though
Mm.
it wasn't luxury, it was affordable housing, slab construction, vinyl exterior, but just a nice little property. And it was a good way to get started as a lead operator. As you well know, there are a lot of balls in the air moving that you have to keep track
Yeah.
of. And fortunately, I found a good partner to kind of handle what I wasn't good at and what I didn't enjoy. And once I found him, then I was able to kind of really move into the lead sponsorship role.
How big of a transition? Like what from a single, you'd done a lot of stuff. It's not like this was your first foray into owning rental properties. How big of a transition was it? And big of a learning curve was it?
Yeah. So yeah, good question. Fortunately, I had a good broker with me as well as a good debt broker. So one of the big learning curves was we obtained Freddie small balance debt on the property,
Assumed
and
it, or did you
new debt,
new
new
debt?
debt.
Okay.
Yep. And of course, through my career, I had borrowed lots of money, single family loans, 2 to 4 unit loans. And as you know, once you get over 5 units, it changes a little bit. And
Yeah.
when you get into agency debt, it's a whole different thing. So that was
Yeah.
a big learning curve. Uh, One of my mentors served as KP because, for your listeners, in order to get agency debt, you have to kind of have prior agency debt experience, which kind of seems like a catch 22. And so brought my mentor in as key principal to sign for the agency debt along with my partner and I. So the process of getting the agency debt was eye opening. I got frustrated at times. My debt broker talked me through it, got it all done, got a great loan, and we're sitting pretty right now with about another 4 years of fixed rate debt.
Love it.
Uh, the other learning experience is raising capital. This was a $2.8 million purchase. And we wanted to raise about $1.5 million. My partner and I thought we could raise $1.5 million. I've raised money for flips. I've raised money for long-term buy and
Sure.
hold rentals,
Sure.
but raising for multifamily a much bigger amount, you don't know. So the raise actually went well, but that was the other part of the learning curve, is to actually how to talk to investors, get them to buy into the program, and kind of bring the whole thing across the finish line.
Yeah. Did you do anything kind of on the front end to start to talk to your investors about this transition? Like, did you prep them that you were going this route, or how did you do that? Because I feel like if you just go from, hey, I'm a single family guy, to all of a sudden, hey, here's this deal, they're like, wait a second here.
Yeah, 100%. So basically, when I made the decision to move into multifamily, which would have been spring of 2020, and the first acquisition took a year to find. You know how it is.
Yeah.
You look, you
Oh,
got to
yeah.
find something that works. You got to build credibility with the brokers. So I had started building my platform spring of 2020.
Okay.
So by the time it came around, it was a year later. And ramping up to it, I had made a few LP investments. And I had also done a few smaller 6 and 12 unit acquisitions kind of with my investor friends here that are local. So
Mm.
I kind of ramped up to it. And it may be old school, but I think there's a sequential path to growth. And if you do it in a systematic manner, you create a good foundation, which provides support when times turn difficult. And I think
Yeah.
as we're seeing in this market now, there are people who jumped in with limited experience, got way over their skis, and are now having some trouble. And it's usually a common thread, relatively inexperienced operators who kind of got into the business, maybe 6 years ago, 5 years ago. And so I believe kind of slow and steady growth. And that's what I've kind of done in my multifamily business.
Yeah, and I could agree. I can agree with that. I mean, I did it that way, and sometimes I go, man, I wish I would have just jumped from the 1 to 4 family straight into the large multifamily because some of these 20 unit buildings and so on were just a pain in the butt. However, even though they were a pain, they gave me a lot of learning experiences along the way that has made me a better investor in the larger space. Now, I still make mistakes. Don't get me wrong. There's plenty of mistakes to be had, but I do agree. I think if you can set that foundation, like you said, and grow into the space, I feel like that's a better path than just jumping straight in. Now, their argument could be said to jump straight in, certainly, but I think the vast majority of people should do exactly what you said.
Yeah, and I imagine you'll agree with this. I'm almost sure you'll agree with this. When you are the steward of other people's capital, there's actually a higher level of responsibility. Like if you and I ran out and we bought some property for our own account and we messed up, well, we're adults.
Yeah,
We'll suffer the pain.
yeah,
So I always say one of my pet sayings is learn with your own capital, not other people's capital. So
100%.
and then I think the other thing is as you grow, you have to put together your team. And that could be vendors, property managers, contractors, lenders, other general partners within your firm. And I think it takes time to find the right people. Uh, and as you scale up, I think you definitely need kind of a larger, more experienced team to run it. So it it takes time to put together the proper team. What do people say? It's like getting married. So don't get married on your first rodeo or first date, whatever the
Yeah.
expression is. So it takes time to build those relationships, see how people interact, and then when you know you've got that solid team, then you can go tackle more because it's kind of been tested.
Yeah, no, I love that, and that doesn't mean you to go as slow as possible, not take action, right? That just means to be smart about it, and you know take don't. I think in today's social media crazed world, we all want instant gratification more than we've ever wanted before. And we think we're a failure if we don't buy that 200 unit building that somebody else bought. And we see them as, wow, look at what they're doing. But we didn't see the journey that they took necessarily. We see where they're at right now. And so we want to do the same thing. But we want to do it today. And we think we're a failure if we don't do it today. And it's funny, like, look, I mean, if you look at, you took a lot of years before you pulled the trigger on larger buildings. You got a lot of experience. It, I think it's just so many people want it done when they're like 20. They just expect they're 20, 25, 30, whatever the age they're at. They're like, I can't wait. I got to get it done now because I'm just going to be too old otherwise.
Yeah, and so yes, Americans by and large are very impatient. Okay, so we'll admit our own foibles. The other part of it is real estate in my mind, has always been a long-term investing strategy. And
Yeah.
of course, in 2018, 19, 2020, we lost that. And people then became thinking that flipping apartment buildings is standard operating procedure. And I would submit, no, the wealthiest families in the world just buy real estate and hold it long term, and that's the more probable path to creating wealth. Um, so I think real estate, it by its nature, is more a long term investment. And I think the other thing we also have to realize, and this is something that makes what we do important, people are living longer, so we have longer life expectancy. So kind of the old model of work, retire, live off your savings doesn't really work
Yeah.
anymore. And so when you think, if you're 30 years old, you still have another 50 or 60 productive years easy.
Yeah.
And so you don't got to get it all at once, just build it. And then that the snowball effect, that the snowball gets bigger and bigger, and then it has a certain momentum.
Mm-hmm.
And that's how I kind of approach investing, as opposed, the other way I say it, I try to hit line drive base hits as opposed to swinging for the grand slam. And again, uh, people do hit grand slams and everybody goes crazy, but a lot of teams can win by hitting line drive base hits. So it
Yeah.
just kind of depends what your emotional makeup is and your risk tolerance kind of thing.
Yeah. And I think, if you're going for the grand slam every time, you're going to get plenty of pop outs. Right. And so if you
Or
can,
K.
yeah, right. So if you can go for those base hits, you're going to, it's going to take longer, but it's going to be a lot more chance of success to get there versus the big failures along the way. Now, again, we're all going to have learning experiences no matter what we do, but there's just a lot less risk in that. I love that you said the wealthiest families hold properties long term and don't flip, because I totally agree with that. And I've made several posts on that and talk about it. And it's like there's just this craze. There was just this huge craze of flipping. Everybody wanted to flip a property. And I think LPs they got so wrapped up in that excitement. Everybody got so wrapped up in the excitement of flipping properties so quickly. That's not real estate. If you want to flip properties, I just don't feel like that is multifamily commercial style size real estate. Can it be done? Yeah, it can be done, but and it still will be done. And I probably still will flip an apartment or two, but it's the vast majority of deals, in my opinion, should not be flipped. And and that had such a high amount of risk to it. This is a slow, steady, not get rich quick, but get rich for sure type of game. And so yeah, I'm so glad you said that.
Yeah, 100%. And the way the way I see many of these multifamily purchases going, you'll find a property that either needs some renovation and an upgrade, or maybe some operational improvements.
Yeah.
So there are things that can be done to improve the property. And in my experience, it generally takes a year or two to work through all of these issues and upgrade the property. So the way I look at it, you put the effort in early in the acquisition cycle, you get that property tuned up and humming like a well-oiled car machine, and then why not kick back a little bit and let what you've created run and
Yeah.
just operate smoothly, throw out cash. Rents are going to increase over time. So your cash flow is going up. You're probably paying down the loan a little bit. And so you put the effort in, get this property tuned up, maybe enjoy the ride around the block for a couple years. And of course, when you finish that one property, you then go on to another and do the same thing. But the idea is, why not reap the benefits of the effort you put into this property? And of course, anytime you sell, the question is, can I find something better? And I would submit, often the property you got that that you've already got control of, your money's just as well sitting there as it is into some other venture. So, and of course, COVID and our response to COVID in terms of printing money, interest rates, that was a once in a lifetime lightning bolt.
Yeah.
And to expect that to happen again, and that's really what caused all the flipping, really, and the drop in cap rates.
For sure.
As an investor, I'm not going to bet on that happening again.
Yeah, it'll happen again at some point in time, but when is that? We'll see. But there will be over exuberance at one point in time again. But yeah, one of probably my favorite property that we have is a property. It's a multifamily property. We purchased it, we renovated, we did exactly what you just said, and then we allowed the cash flow to kick in, and we are returning an amazing amount of cash flow to investors. And we refinanced that property, gave our investors 100% of their capital back, no tax consequences, and they're still cash flowing really well, and we're cash flowing really well. And it's like you said, it's a well-oiled machine. Now it's not perfection. We still want to get to perfection, but we're still making tweaks. But at the same time, it's a great property because we're just running it, and it's cash flow. And we've owned it for 5 years. We'll see. We might own it for 5 more years. We might own it for 10 more years. I don't know, but it's running on, basically just cruise control.
And there's nothing wrong with that. Nothing wrong with that.
Yeah.
Right.
Love it. I want to talk a little bit about, your time in the markets and understanding real estate and what you've seen throughout the years, and then maybe diving into kind of what you're seeing, today and opportunities. So let's talk about just kind of what you've seen throughout the years in the real estate market. And I'm just talking, more macro level and going through different cycles.
Yeah, so it's a great question. And one advantage of being old and having 46 years in the business, I've been through a few cycles, and common patterns do present themselves when you study the past. And generally, what I've seen in the real estate market is there's generally 5, 6, maybe 7 years of fairly good growth. You could call it a boom, increasing values, increasing rents. And then invariably, there's a little bit of a correction. And so you might have a year or two of down. But the down, in my experience, has been 10 to 15% of the up over the 7 years, however long it is. And so you have a steadily increasing market. You have a little bit of a correction. Then typically what I see is you have like kind of a year or two of stable. And then that sets the floor for the next run up, right? And so the floor is ever increasing higher. And I remember a post you once wrote about an 18-year cycle of real estate and economic activity. I kind of see it as 10 years, but of course, half of 18 is basically 10. And so that they seem to repeat. So mostly up, slight down, flat, and then that sets the other thing, that sets the runway for the next ramp up. And so with real estate, as long as you buy it, leverage it properly, and I'm a big proponent on fixed rate debt. Fixed rate debt is one of the real advantages in real estate. Yes, you can borrow on margin against your stock, but it's usually prime plus something. So long-term fixed rate debt is a big advantage for real estate. If you get fixed rate debt, don't over leverage, and you have ample cash reserves for when Murphy's Law strikes or a rainy day occurs, you can own the property for as long as you want, and the
Yeah.
long-term cycle is going to be up. So I've seen probably 2 or 3 of these cycles, and certainly in multifamily, we saw a run up for about 10 years, perhaps extended a little bit by our response to COVID. And now we've seen a natural drop down, but I think we're reestablishing a plateau, and I don't think it changes the fundamentals. I ask investors, do you believe the price of houses or rent is going to be lower 5 to 10 years from now than it is today? I have
Yeah.
a hard time finding any logical argument that would support that
Yeah.
point. So the fundamentals are good. We know we have a lack of housing, and it's particularly in the affordable range. And of course, that's right where multifamily sits.
Yeah. Yeah. It's easy to think that could stay forever, but it never does. I remember I was sitting in a real estate, I used to have my real estate license, my salesperson license, and I was sitting in a class, and this teacher says, every single house in Minnesota will be worth over $1 million in my lifetime. And this was like 2011, right? Everything just, the whole universe crashed. It was like
Yeah.
everybody was on fire. And so, but people behind me are like laughing. And I remember hearing them say like, what, this guy's crazy. Real estate will never get back to where it was, just a few years ago. That's what they thought of it. And guess what happened? Sure enough, it got back and higher, much higher than what it was at the last peak. And so,
Yeah.
just like you said, it's always upward. It has some downs, but it's always upward. And there's nothing that could make you believe that it would, in my opinion, nothing that could make you believe that it'll go down and stay down.
Yeah, I agree. And in my experience, the only time people have gotten hurt in real estate is when they over leveraged and did not have ample cash reserves, get themselves in a bind where they can no longer sustain the property. And it happens to be in a period when the market's down and they're basically forced to sell. Absent that scenario, uh, it's not a sure thing, of course, but the odds are in your favor if you do it right and just hold long term.
Yeah. Yeah.
Yeah.
What are you seeing today? What are you excited about today? And or I guess cautious about, excited about what's going on today.
Yeah. So I guess I'm somewhat excited that uh, the market isn't quite as frothy as it was the last couple years,
Yeah.
and that people are understanding uh, operational ability actually matters. That experience matters. As my dad used to say, in a hot market, anybody can lean up against a garage and sell a house. That's all you got to do. But in a down market, you actually have to be a professional to get the sale across the finish line. And so I'm excited that I think we're going to get to a return of a little bit more professional activity in the multifamily space, and in maybe commercial real estate in general. Uh, I'm an optimist. I think long term, I'm still a buyer. Uh, I look for quality properties in quality locations. And if I find a property that I like that makes sense today with today's debt, I'm a buyer. I'm going to buy it.
Yeah.
Even if I knew the value of that property could decrease a little bit over the next 12 months,
Yeah.
I don't really care because my
Okay.
finish line isn't 12 months from now, it's
Yeah.
that. And so if you see a quality property and you can get it at a price that makes sense, I'm a buyer. So I'm excited about that. I think long-term real estate's going to be good. And I'm actively looking for properties, not easy to find, but you got to stay patient, as you know, and not chase after something that isn't right.
Yeah. If you go by your, what you previously said, the boom, then the quote unquote, maybe not bust, but the down, right?
Correction,
The
correction.
correction, yeah, the couple years of correction, and then the couple years of flat. You might buy today, and like you said, you might in 12 months your property might be worth less. That's what I was doing. That's what you were doing in 2008 through 2000. Well, that was like a 5-year period of time, right? It was all the way to probably 2013 where prices were either flat or going down. You weren't making money on your purchase, but what you were making money on is future appreciation. So from 2013 to today, the prices have gone up. And so you have seen a short-term plan. If you would have bought that and you would have had to sell it in a year, that wouldn't have been good. Unless you could have created enough value, right? That wouldn't have been a good thing. But if you held on to it for a long period of time, you did well. This could be potentially that same type of scenario. I see these some of these offerings where it's like a 2 or 3 year hold, right, on an apartment. And they're flipping apartments again, like we talked about. And that's what would get me nervous, is that we don't. If you're saying, hey, in 12 months we could be less, and then it's going to take 2 years to be flat. Well, that's 3 years, right? And you're
Yeah.
stuck with the same value of the property. That's risky. But if you've got a longer term horizon, you're absolutely right. There's no sense in waiting to the bottom to buy.
Yeah, I mean that we could unpack that all day. I'm not a big believer in the ability to time the
To,
market.
yeah, predict it.
Right. I mean, one, you don't know what the top or bottom is until
Yeah.
12 months after the fact. And then even how you define the top and bottom
Mm,
depend on how you define the time frame.
yep.
Uh, the so that's not how I approach it. I'm a pretty savvy guy, been in the real estate a long time, but I'm also have a certain degree of humility. Uh, and I ask people, do we really have any idea what the world's going to be like in 5 years? What
Yeah.
interest rates are going to be like? What cap rates are going to be right? Like, and if you're honest, the answer is I don't know. We just got to see. And so I think with investing, you have to kind of take that perspective. One of the things I say to my investors is I can't control what the Fed's going to do, can't control what interest rates, can't control the world economy, the national, the local economy. So the only thing I can do when you invest with me and we buy an asset, the only thing I can really do is operate that asset professionally.
Yeah.
That's what you're hiring me for. That's why you're entrusting my capital. If I do that, I've met my fiduciary duty to my investors because I have no control over this. And if rates go down, I'm going to look like a hero. If they don't, I still want to provide a safe investment. So I think savvy investors understand that there are factors outside of people's control that's
Yep.
ultimately going to impact the actual returns. But as professional investors, as operators, we just have to run that asset as good as we can. And if we do that, we've met our duty. And you can look yourself in the mirror, and your investors will appreciate that even during tough times, you still got the job done. You still kept the ship going in the right direction. So
Yeah. Yeah.
I think people have to understand that there's a lot outside our control. There's a lot unknown, and we just kind of gotta live it and adjust as we go. It's the same thing people will ask, well, how long are you going to hold the property? It depends. You buy one, and 3 years later, somebody comes by and gives you a knock your socks off offer. You might take it. If rates low, maybe you refi, return capital like you've done on some of your deals. So you have to adjust to the market conditions.
Yep. Absolutely. And the one thing about a pro forma that I can guarantee is it's going to be wrong. Let's hope that it's wrong in the right way, but it's going to be wrong 100% of the time. So
Yes.
that's, I tell that to my investors all the time. Like, look, because they want to dive in so deep into the pro forma sometimes. And it's like, look, guys, look, One thing I can guarantee you is this is wrong. It just is.
Yeah, people are worried about, $25 here and there, and it's within the range of error.
Yeah.
So it's more a broad look at
This
it.
is a
And
broad look. Yeah.
it's a broad look. And what I see with my own performance, uh, some expenses we've underestimated, some we've overestimated,
sure.
and it just kind of goes that way. So it, you need to do the performa, you need to kind of understand it. And I think the real benefit is kind of doing the what if scenarios when you adjust certain parameters and you kind of see how that changes the return metrics. That kind of gives you an idea of how the deal can operate based on different scenarios. And people always use conservative underwriting. It's become a cliche. We try to do realistic underwriting.
Mm.
We know our market, and that's the other thing. My group is in Greenville, South Carolina. That's the only place we invest. We know this market, and so we try to use realistic projections about what we think the future will be based on our local experience. And that's all you can do. So we try to go realistic and err a little on conservative because people are happy if they get more than less, so you try to be a little on the cautious side, but we try to call it the way we see it.
Yeah. I love that.
Yeah.
I love that. Okay. This has been great. Ton of awesome information. I want to wrap up here, and I got a couple last questions I want to ask you. So what's a book that you can recommend to our listeners?
Well, so I do a lot of personal growth work, helps in my personal life and business. So I would recommend The Power of Now by Ekhart Tolle. And it's an old book, but basically it kind of talks about, to the degree you can stay in the present, everything's okay. You can focus and be productive. People get in trouble if they get out too far in front or spend too much time thinking about the past. So being present in the moment, the power of now, has been a big help to me.
Love it. What's a
Yeah.
mistake that you've made, and how have you learned from it?
Um, so I think you mentioned something to the effect that people can get caught up in the excitement,
Mm.
the energy, and kind of get carried around along with the flow, the optimism, and so forth. So, in my investing life, I have probably suffered from that on one or two occasions and made some bad investment decisions, kind of thinking that when things were really good, that's how they're going to always be. And if you base your assumptions on that continuing, you could hurt yourself. So I've made a few bad investment decisions by getting kind of carried away in the excitement of the moment. The one thing I would say, the mistakes I've made have never been mortal. They cost me money. I learned, but I was able to stay in the game, and it just didn't totally knock me out. So they weren't mortal wounds. I was able to return. And of course, that's made me a better investor, right? Once you make one or two mistakes, if you're paying attention, you don't make those same
That's the
mistakes
key.
again, right? Right. You got to pay attention. Some people keep repeating them, but me, once or twice is good enough. That's all I need. I just.
Yeah, if you got the same wound in the same spot time after time
Yeah.
again, you're just gonna lose a limb, and that's not okay.
Yeah.
All right. So last question I got for you. What are your three pillars of wealth creation?
Yeah, great question. And I would say number one, most important, one needs to live below their means. Uh, when I went to work with my dad, who was born 1921 and actually lived through the Depression, uh, he said to me, "Pay yourself first." And I was a young whippersnapper, 23, didn't really know what that meant. He goes, take 10% of every paycheck and put it away and don't spend it. So I would say live below your means. What that does is it creates capital that then can be invested. So live below your means, invest the delta, right? Invest that delta. And the way I look at that is those dollars invested get up and go to work for you every day, right? They put on their lunch bucket, their suit. So live below your means, invest the delta, and have a long-term perspective. Those are my three keys. We had a significant stock market incident here earlier in the week. And I put out a short little Facebook post. Don't panic. This too will pass. And so when you have that long-term mindset and you just keep that capital working for you, you are going to create wealth. So those are my three pillars of wealth. Nothing fancy, kind of common sense, but if you follow it. And I think the other thing I would say, I love real estate and I believe in it 100%, but I also believe in diversification. And so I think the more important thing is having capital invested in something is better than spending it. Okay. So, right. It's more about having it invested and not spending it. That's really the key to create the wealth.
Yeah, it's so true. If it's not in real estate, it's fine as long as it's not being spent every last penny of it being spent. So
correct.
Love it. Man, Arn, this has been great. Really appreciate it. Appreciate your time. And, congratulations to your success, and looking forward to just seeing you continue to be successful. And thanks a lot, my friend.
Yeah, no, thanks, Todd. And I can tell by our interactions, we approach investing in many similar ways. So it's always nice to talk to a kindred soul who's been through battles. And, basically you're a real pro, and your investors should be happy you're helping them with, grow their capital and net worth.
Yeah, thank you, man. I appreciate that. You
Yeah.
have a fantastic rest of the day. Hey,
You
thanks
too.
so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience, and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.